Institutional positioning adjusts, fresh capital enters and exits. Technical levels that held through the end of May will be tested again with fresh intensity as June opens. Silver is sitting at a technical crossroads right now. The price is compressed. Volatility has been suppressed. And suppressed volatility in silver historically does not last. What happens next could shock most investors. If silver breaks upward through the resistance zone that capped May, the next leg of the move could be rapid and significant. The technical structure suggests that a breakout from this compression could target levels that would represent a 20 to 30% move from current prices. That is not a guaranteed outcome. But it is a realistic one given the convergence of factors we are discussing. On the bearish side, the risks are real and should be acknowledged clearly. If broader risk assets sell off sharply, if a deflationary shock hits global markets unexpectedly, silver will not be immune to that pressure. It is a market that can be volatile in both directions, and investors who are not prepared for short-term drawdowns have been caught off guard before. But here is the critical distinction between this moment and past corrections. The fundamental supply deficit is real. The monetary policy uncertainty is real. The geopolitical realignment away from dollar-denominated assets is real. These are not speculative narratives. These are documented, measurable trends that are reshaping capital allocation at the institutional level right now. Short-term volatility does not change the direction that these forces are pushing silver over the medium and long term. And for investors who are looking at this from a wealth preservation perspective, particularly those in Europe watching the purchasing power of their euros erode year after year, the question is no longer whether silver belongs in a serious portfolio. The question is how much exposure is appropriate given the risks on the table. Let us talk about what the different scenarios ahead could mean in concrete terms. In the bullish scenario, silver breaks out of its May compression, industrial demand data continues to outpace supply through the second half of the year, the Federal Reserve pivots more aggressively than markets expect, and the dollar weakens significantly. In that environment, silver at $40 becomes not a ceiling but a milestone on the way to levels we have not seen in over a decade. In the more cautious scenario, silver consolidates further through the early weeks of June, testing investor patience before eventually breaking higher as the fundamental case reasserts itself. In that scenario, the opportunity window stays open, but investors who wait for confirmation may find themselves chasing a move that has already happened. In the genuinely bearish scenario, a global credit event, a banking crisis, or a sudden deflationary shock drives all assets lower in a rush for liquidity. Silver pulls back sharply in the short term as it did briefly during previous crisis moments, but history shows clearly that silver recovers from those liquidity-driven sell-offs faster than almost any other asset, because the fundamental demand story remains intact regardless of short-term panic. The key message across all three scenarios is the same. Preparation matters more than prediction. The investors who will benefit most from wherever silver goes from here are the ones who made decisions based on fundamentals before the price forced the narrative, not the ones who waited until the headline said silver was already up 30%. This is a moment that requires clarity, not hesitation. The week May close was not a defeat for silver bulls. It was compression. It was a coiled spring. And in markets, compression followed by catalysts does not release gently. The next 48 hours will tell us a great deal about the direction and the intensity of what comes next. Make sure you are positioned and informed before that move unfolds. If this analysis gave you value today, subscribe to this channel right now and turn on notifications. We cover these markets every week with the depth and seriousness they deserve. Drop the word gold or silver in the comments below and let us know which metal you are watching most closely right now. Your comment helps this channel reach more investors who need to hear this analysis before the window closes. Stay sharp, stay prepared, and we will see you in the next video. Something is building in the silver market right now, and most investors are completely unprepared for what may be about to happen. Silver just closed out the month of May in a way that has veteran traders sitting up straight. The price action was weak, the sentiment was cautious, and on the surface it looked like just another disappointing month for silver bulls. But here's what almost nobody's talking about. Weak closes in silver at specific moments in the economic cycle have historically preceded some of the most explosive upside moves in the entire commodity market. And right now, every major signal that matters is quietly lining up behind the scenes. In the next 48 hours, a combination of technical pressure, institutional repositioning, and macroeconomic catalysts could converge in a way that forces silver to make a decision. And when silver makes that kind of decision, it rarely does it slowly. If you hold silver, if you are considering silver, or if you simply want to understand what is happening inside one of the most important markets in the world right now, you need to watch this entire video. Because what we are about to walk through could define your financial positioning for the rest of the year. Let's start with the close itself, because the details matter enormously here. Silver ended May under pressure, failing to hold key technical levels that analysts had been watching closely throughout the final weeks of the month. On the surface, that sounds bearish, but markets are rarely what they appear to be on the surface. When you zoom out and look at what was happening beneath the price action, a very different picture begins to emerge. Open interest on the COMEX stayed stubbornly elevated even as prices drifted lower. That is a critical signal. When open interest remains high during a price pullback, it typically means that large institutional players are not abandoning their positions. They are holding. They are waiting. And in many cases, they are quietly adding. Now pay close attention because this is where the story gets serious. The COMEX data for May revealed something that should concern every investor watching this market. Physical silver registered stocks, meaning the silver that is actually available for delivery, have been declining steadily. Not collapsing dramatically, but eroding quietly, month after month, in a way that the mainstream financial media has almost completely ignored. When paper contracts pile up against a shrinking pool of deliverable physical metal, the conditions for a violent price reconciliation are put in place. This is not a theory. This is the mechanical reality of how commodity markets function. And right now, those mechanics are under serious stress. Let us step back and look at the broader macroeconomic context, because silver does not exist in a vacuum. The European Central Bank is navigating one of the most difficult monetary environments in its history. Inflation across the Eurozone, while officially moderating, remains embedded in services, in energy transition costs, in wage pressures that are proving far stickier than policymakers initially projected. The ECB is caught between a fractured political landscape in Europe and an economy that is slowing far more sharply than the official forecasts suggested it would. Rate cuts that were supposed to stimulate growth are instead being interpreted by markets as a sign that something deeper is wrong. Meanwhile, the Federal Reserve in the United States is facing its own credibility crisis. The dollar has been under quiet but persistent pressure as markets question whether the Fed actually has the tools to bring inflation durably back to target without triggering a recession severe enough to force emergency policy reversals. This matters for silver in a direct and powerful way. Silver is priced in dollars. When dollar confidence erodes, the relative value of silver increases. When both the dollar and the euro are under pressure simultaneously, which is precisely the environment we are moving into, the case for hard assets becomes not just reasonable, but urgent. But here is what almost nobody is talking about. The industrial demand side of the silver equation is creating a structural supply crunch that has nothing to do with monetary policy at all. Solar panel manufacturing, electric vehicle production, advanced electronics, artificial intelligence infrastructure, all of these sectors consume silver at rates that are accelerating faster than mining supply can possibly keep up with. The Silver Institute's most recent data points to a global silver market deficit that is now entering its 5th consecutive year. 5 years of demand outpacing supply. And yet silver sits here, having closed May weekly as if the world has not noticed. Smart money has noticed. This is exactly why institutional positioning in silver has been shifting quietly but decisively over the past several months. Hedge funds that typically ignore precious metals have been adding silver exposure. Sovereign wealth funds in Asia and the Middle East have been diversifying aggressively into physical precious metals as geopolitical fault lines deepen. Central banks around the world broke all-time records for gold purchases in recent years, and that same logic, the logic of holding assets outside of the dollar-dominated financial system, is beginning to flow into silver with increasing force. Now let us talk about the next 48 hours specifically, because timing matters in this conversation. The beginning of a new month in commodity markets is never neutral. New monthly contracts roll,